The markets are currently closed as of this recording on Saturday, November 29, 2025, but the story unfolding with GameStop Corp is anything but dormant. We closed the trading session this past Friday with GameStop stock priced at $21.63, though we saw continued buying pressure in the after-hours session, pushing the ticker up to roughly $22.64. If you look at the intraday chart from Friday, you might see a standard consolidation pattern, but zooming out just a fraction reveals a tension that is palpable across every trading desk and retail forum on the internet. While the headline number is $21.63, the reality sitting underneath that price tag is a discrepancy so massive that it borders on the absurd. Most casual observers and traditional analysts still talk about GameStop as a struggling mall-based retailer trying to sell physical video games in a digital download world. That is the expectation. It is the comfortable, easy narrative that justifies betting against the company. The reality, however, is that you are no longer looking at a retailer. You are looking at a flush holding company. A fortress of liquidity disguised as a nostalgic shop, currently sitting on a cash and short-term investment pile of nearly $8.7 billion. When you compare that cash position to its market capitalization of roughly $10.1 billion, you realize the market is valuing the actual operating business, the stores, the brand, the inventory, the logistics network, at next to nothing. This is the disconnect that keeps the short thesis awake at night and fuels the relentless enthusiasm of the retail investor base. The momentum we are seeing right now, specifically the 7.4% climb over the past week, isn't just random noise. It is a direct response to a convergence of catalysts that are forcing investors to reevaluate what they actually own when they buy GME. We have the third quarter earnings report looming on the horizon, expected around December 9, and the options market is already pricing in massive volatility. Implied volatility has spiked, with market makers anticipating a swing of over 9% immediately following the print. This kind of premium in the options market usually signals that the street knows something big is brewing, or at least that they are terrified of being on the wrong side of a surprise. But what makes this specific moment in late 2025 so fascinating isn't just the earnings. It is the ghosts of the past resurfacing to haunt the bears. Just recently, Michael Burry, the famous Big Short investor who was arguably the first institutional bull on GameStop way back in 2019, posted an old email exchange on social media involving himself and Ryan Cohen. This simple act reignited the fervor around the stock, reminding everyone that the original thesis wasn't just about a squeeze, it was about deep value. And today that value proposition has morphed from undervalued retailer to overcapitalized investment vehicle. When you look at the recent price action, you have to contextualize it within the broader market. We have seen Tesla stock and Nvidia stock continue to dominate the tech narrative, sucking up a lot of the oxygen in the room. Yet GameStop manages to maintain a level of volume and engagement that rivals these giants relative to its size. This is partly because the access to markets has never been more democratized. Platforms like Robinhood, with its seamless Robinhood app interface, have made it incredibly easy for a new generation to deploy capital into volatility. Whether you're using Robinhood stock trading for quick execution or utilizing Robinhood fractional shares to build a position slowly, the barrier to entry is zero. This accessibility matters because GameStop's float is aggressively locked up by retail investors who simply refuse to sell. They aren't just trading, they are accumulating. You see similar behavior on SoFi Invest, where the social aspect of the SoFi trading platform reinforces this holding behavior. Users on SoFi Stocks and SoFi ETFs forums constantly discuss the lock the float strategy, creating a floor for the stock price that technical analysis alone cannot explain. Let's strip away the noise and look at the financials that will likely dominate the conversation in December. The expectation is that GameStop will report revenue around $987 million for the quarter. But the revenue number is almost secondary to the bottom line. In the second quarter of this year, we saw a staggering year-over-year increase in net income, up over 1,000% to $168.6 million. This wasn't driven by selling more console bundles. It was driven by interest income. When you have nearly $9 billion in the bank and a high interest rate environment, your money makes money while you sleep. This is the pivot that the critics miss. They criticize the declining software sales, ignoring the fact that Ryan Cohen has effectively turned GameStop into a special-purpose acquisition company that doesn't have a deadline. The company is generating massive cash flow from its Treasury operations, which provides them the runway to shrink the unprofitable retail footprint without burning down the house. This financial discipline is why you see investors on platforms like Interactive Brokers and Fidelity staying the course. The sophisticated retail trader using the Interactive Brokers platform knows how to read a balance sheet. They see the lack of debt, they see the cash per share. They understand that the downside is mathematically limited by the liquidation value of the cash, while the upside is theoretically uncapped if Cohen deploys that capital effectively. Speaking of deploying capital, we have to talk about the elephant in the room, Bitcoin. In March of this year, the GameStop board approved the use of Bitcoin as a Treasury reserve asset. This was a monumental shift that explicitly aligned the company with the digital asset ethos, further endearing it to the crypto-native crowd who might also be trading on Robinhood crypto or holding assets in Fidelity digital wallets. By diversifying the treasury into Bitcoin, GameStop hedged itself against fiat debasement and signaled that it is operating with a 21st century mindset. It's a high-risk, high-reward play that differentiates GME from every other retailer in the mall. While a company like Best Buy is worried about inventory shrink, GameStop is managing a crypto portfolio and earning yield on billions of dollars. This moves the stock into a different category of correlation. It's no longer just a consumer discretionary stock, it's a proxy for market liquidity and risk appetite. However, the road hasn't been entirely smooth, and we need to address the political dimension that has emerged. CEO Ryan Cohen has been vocal on X, the platform formerly known as Twitter, expressing frustration over the new tariffs. His sarcastic comments about the price of an American-made iPhone and his statement that tariffs are turning him into a Dem highlight a very real risk for the company. GameStop's legacy business heavily relies on imported hardware and electronics. If trade wars escalate, margins on the retail side could get crushed. This creates a fascinating tension. The holding company side of the business, the cash and investments, is robust, but the operating side, the stores, is facing macroeconomic headwinds. This is where the narrative of expectation versus reality gets complicated. The expectation is that tariffs kill the retailer. The reality might be that the retailer is already lean enough to survive, or that the investment income simply subsidizes the retail operations until the storm passes. It is a game of endurance. institutional activity also paints a complex picture. We have seen major players like BlackRock and Vanguard increasing their positions in recent quarters, likely due to index rebalancing, but also perhaps recognizing the cash floor. When you manage billions in a Fidelity wealth management account or a Schwab intelligent portfolio, you need exposure to different factors. GameStop has become a unique factor in itself, uncorrelated to the S&P 500 on many days, acting more like a volatility hedge than a stock. This institutional accumulation creates a powder keg effect. With a significant portion of the float locked by insiders and diamond-handed retail investors, many of whom have directly registered their shares to remove them from the lending pool,